Hey everyone, it's Daniel here from etfs. Hope you're all doing well. So I really want to caution one thing. The next inflation report's going to be really important because you're hearing the rhetoric that's coming out from the Fed members that more is needed to be done, right? That we could see rates even reach close to 6% according to Bullard. But I also want to bring up Fed Mester in all of this. Fed Mester, although yes, she is more on the hawkish side of things. Don't get me wrong. She is a hawkish member. There are some dovish members versus hawkish members, but it's very interesting to hear what she has to say, especially when it comes to rates and her projections in the next SEP report, right? So let me go through some of the comments that she said. She says, she may have to revise up her inflation projections in the next SEP in June, right? So thinking that, hey, inflation's probably may even tick up rather than coming down, which may need more tightening from the Fed. She says data confirms inflation is still too high, right? If you look at the PCE number in April, right, it went up. That's not a good sign. She says PCE inflation underscored slow progress. Everything is on the table for June FOMC, right? Even though we got people in the markets, and yes, in the statement, it did signal a pause, but don't forget in the press conference, Jerome Powell left the door open for possibly a rate hike, right? And which she says here. Fed is committed to lowering inflation in a timely way, hasn't seen much sign that the banking stress is affecting credit conditions. So, okay, if the banking issues that were happening before is gone and solved with, then we can go back to tightening. Good news is actually bad for the markets, right? But we're not seeing that with how the equity market's trading, except the bond market. The bond market out there is getting the memo. That's why you're seeing that sell-off in the bond market, right? We had that big jump up during the whole banking crisis that was happening with the regional banks, and now we're reversing a lot of that move right there. Those yields are going up. So the bond market is looking at it and saying, hey, did you hear Mester? Did you hear Bullard? Did you hear the other Fed members? And also, did you notice that that Jerome Powell's leaving the door open still for higher rates? Right? Of course, the bond market can also be wrong, like it was pricing in rate cuts, coming in soon, and now basically going back to more hikes as these Fed members start to communicate it. Now, again, it's you have some of these members communicating it. Some are saying that, hey, things, rates should pause and we should be done with it. But it's going to be very interesting to see when June comes, and especially so important, the CPI report, right? The CPI report, which comes the day before the Fed meeting in June. So you're going to get the CPI report that comes out, and that's going to give you your clue next day whether, the Fed's going to hike rates or not, or maybe just pause, right? So you're going to get that, and like, Mester is saying, they need to see the data in order to make decisions. And if the banking sector is not in any issues, no problems, then we go further ahead with tightening. And then she says, does think that they will have to tighten a bit more, right? So what does that mean, a bit more? Again, does that mean 6%? Does that mean 5.5? Again, I would say that they will, a bit more basically means they're probably going to tighten until something breaks, until some collapse happens. And it's very likely for that to happen, as we've seen previously with the Fed. They always tighten until things break. And this is the only way that they're going to win against inflation is to create a massive break in the economy. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.